So in measuring the mutual fund performance, or in general the fund performance, you already have come to know the train or measure, Sharpe ratio, Jensen alpha, is it? And the information ratio.
Yes, sir.
You have been familiar with these terms. Okay. So in one of the popular measure of portfolio performance is the Sharpe ratio, where risk is approximated by which one, which parameter? Risk is approximated by,
Sigma, total risk.
risk is approximated by sigma. Okay, as a approximation of uh, total risk. Okay, so the thing is that uh, the performance is performance evaluation is a part of the portfolio management process, which was introduced to you in the very beginning of this class. You need to report the performance to your client or to our client, and the client will take decision to continue or discontinue with our fund based on the performance. So naturally, the analysts have a tendency to manipulate this performance measure worldwide, so that they will not face any outflow from the fund. And you know very well, the compensation of the fund manager depends on the assets under management, or in short is known as AUM. Manager's compensation is a function of asset under management. One of the good percentage comes from this one. Percentage of commission comes from the asset under management. So if for some reason the performance does not appear good to the investors will cause the good amount of outflow from the fund, which will reduce this asset under management, which will reduce the compensation enjoyed by the fund managers. So naturally, from this equation, you have to believe, or we have to believe, that managers will have a tendency to reflect that they performed very well. And if for some reason they couldn't perform as expected, there may be tendency, or they may tend to mask their poor performance by manipulating the performance measure. So manipulation is not always in a negative sense. It may be such that performance measure has been presented in a way, uh, the formula or the parameters are used commonly, but when investors will look for or analyze these performance parameters, they have to be aware of the drawbacks of those performance measures. So for each of the performance measure, there is a advantage, there is a disadvantage from different parts of the fund. I mean, from the investor part, there is a advantage and disadvantage of the performance measure shown by the fund managers, and also from the part of fund managers, there is advantage and disadvantage with relation to each of the performance measure they use. So they tend to use the performance measure which reflects that fund managers has done very well. Fund managers have done very well. And if investors are not aware enough to analyze the performance measure and very cautious about the drawbacks of the performance measure, investors or clients tend to disregard or tend to overlook the poor performance of fund. So that is the common phenomenon. So one of the issue that is that I'm trying to show you right now is that uh, when we measure some performance in relation to risk, return in relation to risk, or more precisely excess return or risk premium in relation to risk, we in finance theories or the theorist who provided this type of performance measure, for example, you are very familiar with this performance measure which uses the systematic sigma as a total risk measure. This performance measure was provided by, has been provided by the Sharpe. So they tend to assume that return is normally distributed. When we use the sigma as a measure of total risk, we need to believe that a return has a symmetric distribution. So if return has a symmetric distribution, what does it mean? There is a equal probability for a small loss than a small gain. What do you think? There is a equal probability for a small loss and a small gain, for large loss and large gain. What is the characteristic of normal distribution? When the both parts are symmetric, there is equal probability for a small loss and equivalent amount of a small gain.
Yes, sir.
Okay. So do you believe that return is normally distributed in the market, stock market? Yes or no? I didn't ask to remain silent.
Yes, sir.
So you believe that return is normally distributed in the market, right? But the reality is that return is not normally, return has not been found normally distributed in the market. Return has been found more look like which is negatively skewed distribution. Is it positively skewed or negatively skewed? This one?
Negatively skewed.
It looks like a negatively skewed distribution, right? Okay. It's not perfectly negatively skewed, but it looks like that it is not symmetric, or it is not positively skewed, but it is negatively skewed. Okay. So here you see, if I ask what is the probability that a small gain will be possible, there is a very, in which area is bigger? Which area is bigger? The left area is bigger or the right area is bigger? If we draw the moat here, if I draw the moat here,
Left area.
left is higher probability, left area has the higher probability. Okay. And what about the right area? Right area has the lower probability or lower region. Right area has the lower region.
Yes, sir.
So if I ask you that what is the probability that large loss will occur. You will stay here or you will go in this direction. If I ask for large loss, large loss is lies in this area or in this area?
So the left one.
On the very left region, very left, or
Yes,
extreme
sir.
left, extreme left. So can
Yes,
you immediately observe that there is a low probability of large loss?
yes, sir.
Okay. And if I ask for a small gain and a small loss, a small gain and a small loss, the probability is much higher.
Yes, sir.
The probability is much higher. So it is a kind of characteristic of negatively skewed distribution. So it is the common pattern of return distribution in the market. What you can do, you can collect the market return from the market index data, and if you plot the return in the form of distribution, you would see that it does not look like a normal distribution. It looks like close to negatively skewed distribution. So if it is true that return is more like negatively skewed, return has more negatively skewed distribution, will it be valid if we go for using the sigma as a total risk, for which the underlying condition is that return is normally distributed?
No, sir.
So you have given the answer. The answer is no. And the thing is that another thing is that so when the return is negatively skewed, we see, or we have come to learn, that the sigma is not an appropriate measure of risk. And most often it is observed that sigma understates the risk. Sigma understates the risk. So can anyone tell me how can I write the Sharpe ratio? How can I write the Sharpe ratio?
The portfolio return minus risk-free rate of return divided by sigma.
Sigma of what?
Sigma of the portfolio.
Okay. So if it goes down, why it is going down? Because it is not appropriate, it is understated. Because of the nature in negative skewed distribution in the return, the risk has been understated. If we continue to use the sigma, so in that case, what will happen?
The Sharpe ratio will be over
Sharpe
inflated.
ratio will go up. And it is also possible, as you are not taking the financial derivatives in this semester, right? In this
Yes,
semester,
sir.
you are not taking financial derivatives. And if we add the financial derivatives with the portfolio, and if we buy the call and put option together on same stock or same asset, there is a possibility that the risk is underestimated and the return is overestimated. So in that case, Sharpe ratio will go up even further. So in that case, for the changes or for the problems in the underlying distribution or addition of financial derivatives in the portfolio, the Sharpe ratio can be manipulated. Sharpe ratio can be manipulated. So in that case, Sharpe ratio has gone up. And if we compare two funds, A and B, we have been learned, or we have been taught in class, that go for that fund of which Sharpe ratio is higher or lower.
Say higher.
Sharpe ratio is higher. So we need to be aware of the fact that Sharpe ratio may go up without having any information. For these reasons, what we just have discussed, without having any new information, the Sharpe ratio can be manipulated to reflect a higher value, which may lead investors to believe that the fund is outperforming compared to other funds, though the thing is that the fund is not outperforming. Rather, the methodology or the technology we are using to compare the performance has drawbacks which has not been recognized. So there are still the performance measure which have been introduced to you, the Trainer, Sharpe, or Jensen Alpha. These are not used nowadays. There are some other sophisticated measure of performance, and one reliable measure of performance of fund is the fund alpha. I will try to share how to get the alpha of corporate bond fund. You probably have come to learn the measure of Jensen alpha from your another class. So next thing what we like to discuss right at this moment is the timing. So it is one of the good aspect of looking at the performance of mutual fund. So you probably have used the timing in any game, that he timed well or he didn't time well in his batting or in his bowling. Can you recall when you conclude that someone has a good timing in batting?
Yes,
My
sir.
question is clear.
Yes, sir.
We use this term when someone has done proper timing in batting.
Yes, sir.
Okay, so that this thing is also available and also related to the mutual fund operation. The thing is like this. Let's say right now the general expectation or all other factors are letting us to believe that the market is expected to outperform in the future in this way, right? I'm not inviting other complexities. I'm just assuming that right now our market condition and other variables and other environmental factors, not the physical environment, I'm asking for economic environment and other financial environment, are letting us to believe that market is expected to outperform in the coming years. What do you think? The general expectation is like this right now. That's why the investors and the funds are pouring billion amount of money in the market, and the market transaction is going up, the market volume is going up, market capitalization is reaching to the new record, right? Are you aware of these facts, or I'm just telling some stories which the uh, which do not have the existence? Are you observing this? You see some commercials in your social media that they are inviting you to make investment with them in the market, that they will provide this percentage of return, and they performed well, very well.
Yes, sir.
Okay. The thing is that when the condition is like this and you as a fund manager has anticipated this properly, what will be your tendency? To increase the systematic risk or to decrease the systematic risk? What will be your strategy as a batsman in the market?
Sir, increase the systematic risk.
Increase the systematic risk. So will you be happy if your systematic risk lies in 1?
No, sir, greater than 1.
You will have to maximize this.
Yes,
You
sir.
will try to maximize this. And if you are right now here and you are anticipating that market is expecting to underperform in coming years, at this point, what will be your strategy? To decrease the systematic risk or increase the systematic risk?
Sir, increase.
Increase. You are anticipating that market is expecting to underperform. Market is expected to underperform in coming days. You will go for raising your systematic risk at that moment. What will happen if, say, if your systematic risk is, say, let's say the return for systematic risk is, market return for systematic risk is, say, 5%, and if your beta has been increased from 1 to 2, what will happen to your return? It will be -5%. If market shows the 5% loss, what will happen to you? You will have double loss of the market.
Yes, sir.
If you make your systematic risk 0.5, systematic risk exposure 0.5, what will happen to your loss? If the market loss is -5%, or market loss is 5%, your loss will become half. Is it look like?
Yes, sir.
Okay, so what will be your strategy if you are anticipating that market is expecting to underperform? You will go for increasing systematic risk or decreasing systematic risk?
Decreasing systematic risk.
Decreasing systematic risk. So the thing is that if you anticipate that some factors are expecting to outperform and market is expecting to outperform for that factor, and if the opposite thing happens, that the factor is expected to underperform and market is also expecting to underperform for that factor, and you can, if you anticipate it properly and you take the strategy in a way to ride on that factor, you will ride on that factor and you will drop off yourself from that factor here. In that case, you have a good timing skill. So when we are talking about the systematic risk or the market only, in that case, which is our factor? We are not thinking of other factors like, if I give you other factors, say a small minus big, then high minus low, then momentum. I'm not asking for these factors right at this moment. I'm asking for only which factor? Market factor. So in that condition, if you want to time the market, your expected strategy is to increase the beta when the market is expecting to outperform, and you want to reduce your beta when market is expecting to underperform. At that moment, you want to reduce the beta and here you want to increase the beta. Of which beta? Which beta we are talking about right now? The
Market beta.
market beta, what you are trying to take exposure. Okay. Are you familiar with the sentiment? You're familiar with the sentiment, right? Okay. Sentiment includes what? Sentiment includes mood. Sentiment includes emotion. Sentiment includes pleasure, these things. Okay. So when people, we feel that people have a high sentiment or investors have a high sentiment, what we are expecting to have? People will have a high positive mood, a positive emotion. And when people have a low sentiment, the opposite thing will happen. So
Yes, sir.
if we consider sentiment as a factor, and it has been found that sentiment is one of the factor which is responsible for the differences in the cross section of stock return. So it is well recognized by the Baker and Ugler paper that sentiment is responsible for the differences in the cross section of stock return.
স্যার একটা কোশ্চেন ছিল
Yeah.
স্যার লো সেন্টিমেন্ট বলতে আমরা কি মিন করতেছি
When the sentiment is low, you have a negative mood or you have a bad mood, you have a bad emotion. So the tendency is that what is the outcome? Let me tell you the outcome, then it will be more clear to you.
Yes, sir.
So when there is a high mood or positive mood, let's say the Bayesian expectation of the return from investment in Robi is 10%. Bayesian expectation of return. Can you recall the Bayesian?
Yes, sir.
Okay. When you have a positive mood or you have a positive emotion, will you believe that the return is 10% or you will feel that return is more than 10%?
So more than 10%.
Return is more than 10%.
Sir, এখানে স্যার
which is supporting your additional 2%?
Sir, emotion and sentiment.
And the opposite thing happens.
স্যার এখানে স্যার আমি যেটা বলতে চাচ্ছিলাম স্যার
জি
আমার যে 2% এক্সট্রা রিটার্ন আসছে আমার ইমোশনের কারণে আমার যদি
No, 2% return is not coming. You are expecting
Yes, sir,
2% more.
Yes, sir, I'm expecting 2% more return from my sentiment or market sentiment. স্যার আমি যদি স্যার 2% রিটার্ন কম এক্সপেক্ট করি স্যার সেটাও স্যার মানে সেন্টিমেন্ট স্যার জাস্ট নেগেটিভ সেন্টিমেন্ট
But it is not a sentiment, it's not a kind of individual thing. Sentiment needs to be recognized in a kind of general sentiment.
Yes, sir. Let's say,
I
sir,
mean what is the average sentiment of the market investors?
Sir, market sentiment যদি নেগেটিভ হয় যে মার্কেট স্যার মানুষ মানে বিলিভ
in that
করতেছে না
case
যে
the opposite thing happens. Let's say the risk associated with Robi investment is, say for example, 10% standard deviation. So
Yes,
when
sir.
there is a negative sentiment, people tend to believe that the risk is 15%, not 10%. People will overestimate the risk.
Yes, sir. That's what sir, আমার প্রবলেম স্যার টার্মিনোলজিটা নিয়ে স্যার লো সেন্টিমেন্ট স্যার লো সেন্টিমেন্ট বলতে স্যার হাই রেশনালিটি বোঝানোর কথা কিন্তু
লো সেন্টিমেন্ট
স্যার লো সেন্টিমেন্ট বলতে তো স্যার হাই রেশনালিটি বোঝানোর কথা
No, the rationality has no place for sentiment.
Okay, sir. Thank you.
Have you got it? Rationality is here, base is here. If you are rational, if you are Bayesian, you are here. You should not be here or you should not be here. Am I clear?
Yes, sir. Okay.
Okay, fine. So let's continue. What I'm trying to say, timing. So you will see a good number of literatures where it has been proved that sentiment timing rewards the fund managers. Sentiment timing. So what does sentiment timing means? What does sentiment timing mean? Sentiment is a factor. And I believe that you have come to learn what is about the timing. timing involves in taking exposure in that factor which is anticipated that it will give higher return in the market, and you reduce the exposure in that factor when you anticipate that that factor is expecting to underperform, or that factor will give you low return in coming days. So you take the appropriate decision in that way. So it has been found that uh, when the current sentiment, I mean the present day sentiment is low, and fund managers take exposure, take negative exposure. Fund manager take negative exposure to the sentiment factor, they outperform in the long run. Forget about it, otherwise the thing will get complicated. Just think of the sentiment, the funds or the investment which takes low exposure in the sentiment or negative exposure in the sentiment, they outperform in the future, and the opposite is true. The funds which take high or positive sentiment exposure, they underperform in the future days. So that's why it is recommended that take low and negative exposure in the sentiment factor. So I do not know when the sentiment will go up or when the sentiment will go down. I do not know about it. So if you can anticipate that sentiment is expecting to go up in next 3 months and then it will go down, in that case, what can you do to make profit out of this? You have a belief that the sentiment is expecting to go up in next 3 months, then it will go down. What will be your strategy? If you have a perfect information that sentiment will continue to go up for 3 months and then it will go down, what will you try to do?
স্যার এখন স্যার লং পজিশন নিব আর 3 মাসের পরে স্যার মানে লিকুইডেট করব।
Okay, that is your timing strategy. That is your timing strategy. What you are doing, you are trying to take position in a based on a factor, based on an influencing factor, which is expecting to give higher return in this time, and then this factor will collapse and this factor will not give you a high return, it will give you low return, then you will try to take the reverse position. So that is the way how managers want to time the market. So there are some other factors other than sentiment. So one kind of a strategy related to sentiment is like this. Another factor is like that. For example, you are expecting to believe or you are expecting to see that in coming years or coming 6 months, small stocks will give higher return and big stocks will give poor return. So what will be your strategy? You will take stocks which have high beta to this factor or low beta to this factor. Let me make it more clear. Pharma has developed 2 other factors in addition to the market factor. the existing market factor. Okay. So one of that factor is SMB. And if you go to the Pharma Friends site, the Care Friends site, you will see the return for SMB has been provided. The return for each month for SMB factor has been provided. So you have a portfolio. Okay. Let's think of a stock. So if it is the return difference between a small stock and the big stock. Now, which stock will have a higher beta with this factor, a small stock or big stock? Have you got my question?
স্যার এটা রিপিট করলে বেটার হয়।
If you take a particular stock, you do not know that a stock is small or that a stock is big, and you have taken the return of that stock and you have regressed the return of that stock with the SMB factor, and you have come to know the beta of that stock, and you see that beta is a higher number. And what will be your conclusion? That beta, that stock looks like a small stock or that stock looks like a big stock?
স্যার মোর প্রবাবলি স্মল। স্যার স্মল হওয়ার মানে মনে হচ্ছে স্যার।
Okay. What about others? It is very natural to think that a small stock, it should be a smaller stock. That's why it has a good relation with this factor. And if you see the opposite, the beta is very weaker or beta is in the negative direction, you would conclude that a stock looks like a big or a small. No response from your side.
স্যার বিগ।
Okay. So the thing is that in that case, what you have believed or what you have anticipated that the SMB will outperform, this factor will outperform. In that case, you will include which stocks in your portfolio?
স্যার স্মল
Small
স্টকস।
stocks, more small stocks, or more big stocks?
স্যার মোর স্মল স্টকস।
Okay. And you tend to include those stocks of which the SMB beta is higher.
ইয়েস স্যার।
You tend to include those stocks which has a higher beta in SMB factor, and you tend to sell off those stocks which have low beta with this SMB factor.
ইয়েস স্যার।
Got it? So you need to recognize those factors, and those factors are commonly SMB, HML, momentum in the stock return. And for the bond return, the factors commonly known as are term factor, default factor. We'll learn more about it later. Okay. So you probably have come to learn how to time the market, or not only time the market, time any factor. So that factor can be market factor, that factor can be SMB, that factor can be HML, or that factor can be momentum, that factor can be sentiment factor. Okay. The thing is that how can you change your beta of portfolio? Can anyone tell me how can we get the beta of portfolio from the beta of stock? How can we come up with the beta of portfolio?
স্যার ওয়েটেড এভারেজ।
Weighted average of the
ইন্ডিভিজুয়াল
holding
সিকিউরিটিজ।
securities,
Yes,
holding assets, right?
ইয়েস স্যার।
Okay. So which if you want to increase the beta of your portfolio, market beta of your portfolio, so one common strategy can be to buy the stocks which have a higher beta and to sell the debt instrument, because debt instrument has a low beta, low market beta. If you anticipate that market is expecting to outperform, and if you anticipate that market is expecting to underperform, what you will do?
So lower the beta.
You will sell the stock which have a high beta,
Yes, sir.
and you will buy the stocks which have low beta or negative beta.
Yes, sir.
Okay. And another strategy involves buying the appropriate derivative contracts to manipulate the beta of your portfolio. So when you will have your derivative course, you will see that how the taking position in different different derivatives can help you to change the beta of your portfolio. So if there is a successful timing, you will see a close relation between the stock market return or the overall market return and the beta of your portfolio. And if you see the relation is weak, you will have a conclusion that managers are not timing the market well. So if you look at this diagram or the figure, you see the stock market return moves in this line and bond market return moves in this line. This line is for bond market, this line is for, sorry, yeah, this line is for stock market and this line is for bond market. Okay. So if the market movement looks like this and your beta should have a, you have a very good timing skill, your beta should reflect the same shape of the market return. Does it look like that you have the beta follows the market return here? Beta means your portfolio beta. I mean our portfolio beta. Does our portfolio beta follows the market return in a
Yes.
very good way?
Sir, not in a very good way, but follows.
Follows, but not in a very good way.
Yes, sir.
But if you see this one, it is close to the average one. If you make average and you want to see the average beta of the bond and equity market, average market beta, you will see that your portfolio beta has a very good reflection of that beta. The summary is that there should be a close relation between your portfolio beta and the market return when you are a good timer, and the opposite is true. And alternatively, we can also look at the plot diagram. If we see the relation between the stock portfolio return and the market return are much scattered from the straight line and mix up, some dots are on above of the straight line or and also below the straight line. In that case, the manager is not a good timer. But in opposite case, or which is more desirable in case of timing, when the market is doing very good, in this region in the positive direction, you have a higher beta and you are getting higher return for that, for your strategy. That's why these dots are above the normal expectation line, above the normal line, or above the average beta line. But at the same time, when market is anticipated to underperform, what you have done, you have reduced your beta exposure. So when you have reduced your beta exposure, you will have less loss than market or more loss than market.
Lower amount of loss.
Lower loss than the market. That's why these dots are above this average line, or who are not timing the market properly. It is that line. That's why if the managers are timing the market very well, these dots should lie above the straight line, either in positive direction or in negative direction. So commonly, you see the mutual funds report that they outperform the market. This fund A, for example, in our country, this fund is saying that I have outperformed this market. And what they have done, say they have reported that I have achieved 13% since the inception of our fund. And since the inception of our fund, I mean the inception date of our fund, I mean the fund A, at the same time, DSEX has reported 10% return or 8% return. That's why we have outperformed. Have you seen this kind of reporting? If you have the mutual fund units, or you ever has explored, you have ever have explored the mutual fund prospectus, or not mutual fund prospectus, mutual fund quarterly reports? Have you ever? They tend to compare themselves directly with the market index. Yes, no, no, yes.
Yes, sir. এজ বাংলাদেশেরটা দেখেছি, ওরা একটা নিউজ পেপারে পড়ি নাই, বাট ওদের রিপোর্টে পড়ি নাই, বাট ওদের ফেসবুক পেজে দিছিল কম্পারিজন।
Okay. Do you believe that it is a kind of very valid comparison?
স্যার একটা জিনিস ইগনোর করা হয় এই কম্পারিজনে,
Hmm.
স্যার রিস্ক এক্সপোজারটা, মার্কেটের রিস্ক কত আর ফান্ডের রিস্ক কত।
Okay, that is a good point. You have no idea about the risk exposure taken by the fund A and risk exposure of the overall market. Okay. So the thing is that this, if the securities held in the DSEX, type of securities held in the DSEX, and the securities held in the portfolio of the fund does not look like same, this comparison is not a valid comparison. You would see this fund includes some treasury bond, includes some fixed income securities, includes some investment in what should I say, startup companies. So in that case, can you compare with the DSEX?
No, sir.
You cannot compare with DSEX because you are not following the DSEX, or you are not doing the same what DSEX is doing. Okay, so this is kind of how managers want to misguide the investors to mask their performance. I mean, the performance may be really very good or maybe really not as expected by investors. Okay, so it has been found that a single index benchmark is never adequate enough to understand the performance of a portfolio. Single index is not appropriate enough. So which is known as single index? The single index is commonly known as the what should I say, the general market index or stock market index. We commonly believe that S&P 500 is a general stock market index. Then we tend to believe that Dow Jones index, and in our country we tend to believe that DSCX is a general market index. So we tend to believe that only that index, that general market index, explains the return of our portfolio. But it has been found that instead of recognizing the relation between the portfolio return and the single index return, still there has been a good amount of alpha which cannot be explained well. And at the same time, Pharma French has found that there has been a significant reliable relationship between the alpha continuously reported by the funds and continuously reported by the stocks from the investment with the SMB factor and the HML factor, and Carhart has found that additional factor, momentum factor. So when they have included this index, these factors here, I mean, how many factors are right now? Market, SMB, HML, momentum. It has been found that alpha has become very much insignificant now. Now, if alpha has become very much insignificant, in that case, is there any marginal benefit to make investment with fund manager?
No, sir.
There is no marginal benefit of making investment with fund manager. Rather, what can we do? We can take the SMB beta of my stock, HML beta of my stock, and momentum beta of my stock, and market beta of my stock. And if we see we have this information, we can invest by ourselves. And if market manager is trying to do something extraordinary, they should do something beyond this, beyond the return explained by these factors. So for bond fund, the factors which have been recognized well, these are very basic form. Term, you know the term?
Yes, sir.
You know that the bonds which have a long term provides higher return than the bonds which have a short term.
Yes, sir.
And what we know, which bonds are expected to outperform? The bonds which have a high default risk or low default risk?
Sir, high default risk.
The bonds which have a high default risk, as you are taking more exposure to risk, you are expecting to take higher return. Okay, the thing is that in this kind of benchmark, how many indexes I'm taking right now here? 4 indexes. One is stock market, SMB, HML, then momentum factor. So if you do a time series regression between the stock return you are taking, or if you think of the portfolio return, and if you see that, can we get alpha here? If we do a regression between the portfolio return and these 4 factors, have we learned about the multiple regression from our applied statistics? From our applied statistics, we have learned multiple regression analysis. Can you recall? can't recall? I can't recall because I was there. Okay, let me continue. The time is already up. Okay. Let me finish the session by concluding about the first point in the multi-index benchmark models. The thing is that we need to include those type of index based on the securities held by our portfolio. Say, do we have any bond fund right now? In our country, do we have any bond fund? No answer. So if we have a bond fund, as we do not have a bond fund, but we are expecting to have a bond fund in coming days. And the US market in which I have did a work on corporate bond fund, I have found more than 4,000 corporate bond fund. More than 4,000 corporate bond fund, not only bond fund. Only in case of category of corporate bond fund, I have got around 4,300 corporate bond funds. So the thing is that which indexes we should use in measuring performance. The thing is that we need to look for those indexes which include the securities which also includes in the portfolio in which we are concerned. So if the thing is that our stock includes some small stock, our stock includes some big stocks, or our stocks commonly includes very small stocks or very big stocks, or a small quantity of big stocks. In that case, if we include only the market index, can we get a precise estimation of the alpha, or we should add the SMB factor or SMB return? What do you think? If we include only this, ignoring this, will we get significant alpha or insignificant alpha? We are expecting to have a very significant alpha because we are missing a factor which would influence, which would explain the return difference between the small and big stock. Because our portfolio includes small stocks, our portfolio includes some big stocks, and it has been found that small stocks tend to outperform the big stocks, and big stocks tend to underperform the small stocks. But it has also been found that this factor does not account for this return difference. So for that reason, which factor we should include here to account for this return difference? SMB factor we should include here. Okay. So let me show you. This is the ending of today's class. Let me finish the recording first, then I will show you from where the SMB HML are available.